The softer than expected US inflation data sent the US yields and the US dollar tumbling yesterday, and most sectors roaring except for the technology stocks. So investors' attention turns to earnings today as the release of some major US big banks results officially kicks off the earnings season. So welcome. This is Swissquote's Daily Market Talk. I don't know for the Fed, but investors definitely got the evidence that inflation is on a right path to justify a Federal Reserve rate cut sooner rather than later, after yesterday's CPI report from the US printed a slower than expected set of numbers both for headline and core inflation, and both on a monthly and on a yearly basis. So the monthly headline CPI fell 0.1%. The yearly inflation fell from 3.3 to 3%, and core inflation is from 3.4 to 3.3%. What a blast for the Fed those. So, the US 2-year yield fell by another 10 basis point chunk to around 4.50%, and the US 10-year yield tipped a toe below the 4.17% level before bouncing back above the 4.20% mark. Activity on Fed funds futures show that the probability of a September rate cut from the Fed soared up to 95% and is holding near 92.5% level this morning, while this probability was less than 75% at the same time yesterday morning. So the US dollar index sank shortly below its 200-day moving average, and from a technical perspective, the index is still in the bullish trend above the 104.20 level, which is the major 38.2% Fibonacci retracement on this year's rebound. Yet we now have a stronger case building for a sustainable decline below this level into the medium-term bearish consolidation zone. Now, obviously, the sharp US dollar sell-off sent many major currencies meaningfully higher against the US dollar, but the Japanese yen particularly attracted investors' attentions after the dollar-yen tanked from near 162 to below 159 level in just a single move. The move obviously sparked speculation that the Bank of Japan may have just stepped in and took the opportunity to exacerbate the negative move that we saw in the Japanese yen. So some news outlets backed the rumors, while the Bank of Japan officials just kept silent and kept the suspense running, because the Bank of Japan's FX chief Kanda, for example, said that he would not comment, and he's right, and he's very smart indeed, because not knowing whether yesterday's Japanese yen purchases were or were not fueled by the Bank of Japan makes this intervention way more effective, as you simply don't know if by buying the dip in the dollar yen you are betting against the Bank of Japan, which obviously has only limited resources to make such interventions regularly, or you are betting against thousands of buyers who have actually the power to overhaul the market and make the Japanese yen do better in the medium run. So as a result, we don't know what happened yesterday, but the dollar yen is trading below the 160 level this morning. In the UK, the pound was already bid at yesterday's trading session, especially in the morning, after a stronger than expected growth number from the UK helped traders scale back the expectation of an August cut from the Bank of England from 70% to a coin toss. So combined with rising hawkish voices at the heart of the Bank of England, waning political risks after the general election, and softening US dollar, we could see cable make an attempt on the 130 level. But the fact that the BOE hawks cry louder, doesn't mean that the does are not around. They can, still outnumber the hawks in the August MPC meeting and offer the UK the long-awaited rate relief. Across the channel, the euro-dollar advanced to 109 mark at yesterday's trading session. The single currency got a further support, a further boost from the French finance minister, Mr. Bruno Le Maire, pressing with planned spending cuts in France to reassure the European Union and the markets and investors that France will comply with the European Union rules and not let the debt levels explode following a government change. While the Bank of France chief Mr. François Villeroy warned France against increasing the government debt levels and increasing taxes for companies. So, the fiscal and monetary policy makers' joint efforts in France seem to be paying off this week, with the French 10-year yield back to levels when Emmanuel Macron had called for the snap election, and the CAC 40 is again testing its 200-day moving average offers to the upside on lower French yields and on a revived reflation trade on rising Federal Reserve rate cut expectations. Now, interestingly, the S&P 500 and Nasdaq fell sharply at yesterday's trading session after the US CPI data. So the sharp rise in Fed's rate cut expectations and falling yields looked like they didn't give much support to the major US indices. But in reality, well, they did. They did, because the S&P 500's equal weight index jumped 1.20% yesterday. Almost 400 stocks within the S&P 500 gained at yesterday's trading session. And all sectors gained except for the technology and consumer staples, as it was also dragged down by Amazon, which is a technology stock. But most stocks in the S&P 500 cheered the news yesterday. And the Russell 2000 index soared more than 3.5% to this year's peak level that was reached by the end of March. And also oil gain. Gold jumped past the $2,400 per ounce level as lower yields in the US decreased the opportunity cost of holding the non-interest bearing yellow metal, while the SPDR's metals and mining ETF jumped 2.74%. So the flight from big technology to other sectors, the so-called reflation trade, was big like mountain at yesterday's trading session. But it also came as a proof and a warning that no matter how hard the other sectors rally, if the bleeding in big technology stocks is not contained, well, the major US indices will still suffer. So inside tech, Nvidia lost more than 5.5% yesterday as investors left the safety of big technology, which are rate-proof thanks to AI. Mama stocks fell 2.77%, while Tesla dived almost 8.5% as the sell-off was amplified by the news that the company will delay revealing details on its robo-taxi from August to October this year and use the additional weeks to apparently build additional prototypes. So it sounds something like that the prototypes that they have in hand today are not good enough to keep investors dreaming about a bright future. Now note that Tesla's stock price rallied 11 days in a row after Elon Musk pointed at August 8th robo-taxi reveal. So let's see how many days of sell-off the delay will cost to Tesla. Anyway, today, investors' attention shifts to the earnings season. The US big banks will open the dance as soon as today. Now, shares of big US banks actually outperformed the S&P 500 throughout this year, but the second quarter results may actually look quite mixed as the interest rate environment wasn't necessarily favorable due to a rise in the yields. The net interest income may have remained quite limited due to the sluggish loan growth. Then the non-interest revenues were probably mixed as well due to slowing economic activity across the board, and the credit is still a place to watch, as I said on Monday, given the fears that we have around the commercial real estate. But investors could actually eventually look past the rate-related worries today, as the Fed is now expected to announce the first interest rate cut as early as September this year and cut 3 times before the year ends. This is the expectation as this week's come to the end. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.